You've probably heard a story like this before. My friend bought a property 5 years ago, and now it's gone up by hundreds of thousands. Real estate is such a great investment. Sounds pretty tempting, right? And that's exactly why so many people think property investing is simple. As long as prices keep going up, the earlier you buy, the more profit you make. But that's not the truth. In fact, many people overlook two key parts of property investing. The first is the cost of investing itself. That includes both holding costs and transaction costs, and they can eat into your returns more than you'd expect. But the second point is even more important. The real core of property investing isn't just about prices going up. It's actually about something else, a tool that has the power to really grow your wealth. What is it? I'll reveal that later in the video. So how exactly do these two factors affect your investment returns? Let's break it down with an example. Say you buy an investment property for $1 million, fully paid in cash. Based on historical data, Australian property prices have grown at an average annual rate of around 7% over the past 30 years. So, let's be optimistic and assume that growth continues. That would mean your property is worth about $2 million in 10 years. Sound great, right? But hold on, that's just the change in price, not your actual return. During those 10 years, you're constantly paying to hold the property. Annual fixed costs include things like land tax, council rates, insurance, maintenance, property management fees, and utilities. On average, holding costs run about 2% to 4% of the property's value per year. Let's use the midpoint, 3%. That means you're spending $30,000 a year just to maintain the property. On top of that, there are buying and selling costs, such as stamp duty, agent commissions, legal fees, and so on, which typically total around 5% of the property price. Since those costs are one-off, you can spread them across the 10 years of holding period, which adds another 0.5% per year. So even if the property appreciates 7% annually, you're paying 3% to holding costs and another 0.5% to transaction costs. That leaves you with a net return of just 3.5% per year. This is your annual return if you buy the property in full with cash. And what does 3.5% mean? It's not only lower than the long-term average return of the stock market, but even less than what you can currently get from a one-year term deposit in Australia, which is about 4% to 4.5%. And bank deposits are virtually risk-free. So if you're relying on full cash property purchases to build wealth, the truth is the return is actually quite low. So why do so many people still think property investing is super profitable? Why is there this widespread belief that buying real estate is the path to wealth? The answer is leverage. The real appeal of property investment isn't just the capital gains, it's the ability to access leverage, something that's rarely available in most other types of investments. Let's go back to the same example. You buy a $1 million property, but this time you only put down 20% or $200,000 and borrow the remaining $800,000 from the bank. Let's assume a 5.5% interest rate. If the property price goes up 7% in the first year, that's a gain of $70,000. But your investment was only $200,000, so your return is 35%. Yes, you heard that right. A 7% increase in property price gives you a 35% return on equity. That's the magic of leverage. But of course, we need to factor in costs. In addition to the 3.5% holding and transaction costs we mentioned earlier, you're also paying 5.5% interest on the loan, which is $44,000 per year, about 4.4% of the property value. So your total annual cost is 7.9%. After subtracting that from a 35% gross return, you're still left with a net return of 27.1% per year. That's a very impressive number. And it's this powerful leverage that has created the widespread belief that property equals wealth. So yes, the most attractive part of real estate investing is the leverage. It gives ordinary people a chance to control a $1 million asset with just 20% of the capital. But don't forget, it's a double-edged sword. Leverage amplifies gains, but also magnifies losses. If property prices fall by 5%, your loss isn't just 5%, it's 25%. you lose a quarter of your $200,000 deposit. And if you didn't buy in a prime location, or the area has little growth potential, or you bought during a rate hiking cycle or economic downturn, the property may stagnate or drop in value, and the leverage will only make that worse. Many people take on high leverage at the wrong time and in the wrong place, and it backfires. They don't just miss out on gains, they get stuck or suffer serious losses. I'm not saying property investment is bad. I'm saying it shouldn't be romanticized. Real estate is not a guaranteed win, and it's definitely not an easy path to wealth. Before you buy, you need to calmly and objectively assess your financial goals, cash flow, and risk tolerance. Don't get blinded by headlines about how much prices have gone up. What really matters is whether you picked the right property and whether you used leverage smartly to turn price growth into actual returns. So, have you ever calculated your true net return on a property investment? I'd love to hear your experience in the comments. And if you found this video helpful, don't forget to like and subscribe. I'll see you in the next one.